Good morning, everyone. I'm Vince Lancy. It's Monday morning. Today's market rundown, we're going to be discussing silver bulls. There is a new silver bull in the camp, and we're going to give you a description of what they're suggesting. We're also going to discuss the new Cold War 2.0. It's here, and today's October 7th, the first year after the Israeli-Hamas war started. And I'm declaring that day as the beginning of the Cold War 2.0. We'll get into that. First, the markets. We'll leave silver up for you while we're doing that, since that'll be our flavor today. The dollar is 102.59, up 10. 10-year yields are 4%, up almost 4 basis points. The S&P 500 is 57.22, down 23. Mind you, that's the first time I've seen the stock market actually dipping on a stronger dollar and 10-year yields in the last couple days. The VIX is 21.22, up 2 percentage points. That's very strong. Gold is 26.58, up 5. It was down $3 to $5 all night. Probably liquidation after the world didn't end over the weekend. And now this buying coming in, trust me on this, this buying coming in is in anticipation of US-based ETF buying at 9:30 in the morning. So watch to see what the market does at 9:30. Silver, 31.91, down 27 cents. Off the lows, but a little bit of an unwind after last week's torrid reversal in the gold-silver spread. Copper, up 4 cents, 4.54, so silver and copper diverging a little bit. This is an unwind of Friday's trades. Gold, silver up almost 1. WTI up $1.87, stagflation, Cold War 2.0. Nat gas, 262. Really, you have to buy silver and gold for the next 5 years. You just do. Bitcoin, 62,863. Bitcoin 2, if you're of that flavor. Ethereum, 24.51. Palladium, 10.21, up 12. Platinum down 4 and change. Grains are, drum roll please. Oh, I have to move my chart here. I lost my cursor. Grains are, uh-oh. What did I do? Crisis averted. Soybeans are down 5 cents. Corn is offered unchanged, and wheat is offered unchanged. Scrolling back up. Silver chart there. These are the two levels that matter the most. This matters in the short term. This matters in the long term. In the short term, if we get above here, it's off to the races. People were talking about that a lot last week, and that optimism is spilling over, and it's warranted. However, we're not over it yet. Okay, so if you're buying it in anticipation of it going over, just know that you're pre-ordering. Let's put it that way. Not a bad idea. I've done it before. And this yellow line here, we're going to discuss this in the context of what a bullion bank suggests their clients do as their first foray into silver. Actually, very interesting, if you ask me. All right. Here we are. Silver Bulls Cold War 2.0. First, the homepage. Bullion Bank, our trade of the week focuses on silver. That's what we're going to discuss here. We're going to touch on it. And we're also going to discuss Cold War 2.0, a theory that we've had for some time, but we're declaring it as real today based on this data here. And there's our Sunday reading, extensive reading for subscribers, both free and premium. Starting with Cold War 2.0, the chart that you have up there is a grid of wars as drawn by Michael Hartnett in his weekend report. On the left side are the wars and the years, and on the right side are what gold and oil did during those wars with futures markets or markets that had some sort of transparency. What we've done is on the left-hand side, we've marked it up in orange. And on the right-hand side, we've marked it up in red and green, and we've divided it into eras, E-R-A, eras. On the left-hand side, the title is, this is the U.S. Saudi Arabia pricing partnership during the sole superpower status. So before the status, during the status, and after the status. Before the status goes to a roughly 19, actually goes to 1990. 1990, the status changes and we become closer. And in 2002, we'll say 2022, post-COVID, we'll say that the status frays. And we're going to study the price of gold and oil before, during, and after. And what you'll see is that before is the Cold War, during is when we were the only superpower on Earth, and after is where we are now. So after World War II, the world entered a Cold War era. During that era, the United States and USSR were opposing competitive forces. And during that time, markets reflected those opposing forces. Specifically, markets reflected a more realistic expectation of risk to world economy matters. Even more specifically, during wars, oil went up and gold went up, sometimes a lot. Then in 1990, something happened. The USSR collapsed. And upon its collapse, that left the world with one superpower. That would be the Pax Americana era. During that time frame, markets also reflected one superpower in the world. When there were wars, oil went down. Note the red. Note the red. Gold went down. When there was peace, gold also went down, and oil went down usually. The point is, during this era, the United States asserted itself globally by influencing neighbors, not just with their own pricing, but with what their neighbors could do for them. They influenced trade partners and making itself more popular, let's say indispensable, to potential trade partners or associates that were not really sure they wanted to join the party. One of the key ones, if not the key relationship the United States fostered, was the Middle Eastern relationship, specifically with Saudi Arabia. Now, that relationship had already been underway with oil being priced in dollars going back to 1976 or thereabouts. But when Saddam Hussein invaded Kuwait, post the Russian collapse, USSR collapse, the United States and Saudi Arabia went to a level of cooperation unheard of before then. In no small part because Saudi Arabia was threatened. It wanted the United States to help. There was no other superpower to balance it out. The United States was happy to do that for a price, and the price was lower oil. It wasn't a quid pro quo, to be fair. The U.S. wanted to protect the world or project into the world with advertised pricing of oil that things were okay. Now, there are many ways a market can be managed in price. Let's say rehypothecation, selling the futures that are not tied to physical delivery that you really have no interest in making delivery of would be the one that we're most familiar with in gold. And it's easiest to do in gold. Another way, a more direct way, a more effective way is to have, in the oil market, is to have physical oil pumped into the market. And that's what happened. During the Gulf War, let's call it, the first Gulf War, and the 9/11 attacks, and the Iraqi II war, which all happened during the Pax Americana era, the United States said, we'll take care of it. Just pump oil. Saudi Arabia said, okay, we'll take care of the markets. So the United States military presence in the Middle East, let's say the Gulf War I, people would look to the markets to determine if during that time things were going well or not. You look up at the tape, the markets were a polling device on the success or failure of a mission. And if you looked up on a screen, as I did, oil was down. And that was because the Saudis hit a button and started pumping a lot more oil. They did that because they wanted to help the U.S. project peace, because it was also in their backyard. We bought their oil. We provided a military presence in the Middle East. They pumped oil when we needed it. Elections coming, pump some oil. They pumped oil. After the election, oil went up. There are numerous instances of this, but the relationship was symbiotic. We gave them dollars for oil. They bought weapons with dollars. We gave them military presence. They pumped oil. But that changed. Right after 2020, right after COVID, it was like a line in the sand. Mind you, back then, Sunni and Shia weren't on such good speaking terms, so Iran was actually more of a threat than they are today. However, as I just said, that was supplanted by Chinese demand. The Chinese demand has grown, the need for the US has decreased, and some US dollars are being orphaned. Now, I know the US dollar is doing fine against G7 countries, but don't tell that to gold. All right. The rise of the BRICS brings a superpower collectively to match up against the US. Now, I wouldn't call them literally a superpower because it's a cooperative, but you're seeing their effect everywhere. You're seeing that in the price of gold. Since COVID, we have now entered an era past the superpower dominance of the US. You can say that the BRICS are banding together in an almost attempt to be a unified cooperative superpower, but in many instances they are. They have nuclear capability. They have a significant portion of the world economy. And at least for the moment, they are acting of one mind. And when that happened, the markets went back to Cold War behavior, back to the chart. After Russia-Ukraine war, gold was down, fine. But oil was up 18.5%. And the only reason it went down afterwards, back to unchanged, is because we emptied the SPR. Saudis didn't help us. That war wasn't in their backyard. Israeli-Hamas war. Gold, 3 months later, up 13%. Remember that day, October 7th, a year ago? Gold started a relentless rally and hasn't looked back since then. 6 months later, it's up 26%. Oil, initially down 6.9%. Maybe the Saudis were being kind to us. Who knows? But here we are 6 months later, and it's up 7.8%. We're in a Cold War again, based on the behavior that we're seeing right now in the markets. If the markets are polling devices for world geopolitical cooperation, then markets are discounting a new Cold War. It's that simple. Moving on. Silver bulls. Okay. Our trade of the week focuses on silver. There's a bullion bank. Their name is in the report. Most of their clients are gold focused. And they're now introducing their clients have silver as well, but they're now introducing their clients more aggressively to silver. And let me just read that to you. Our trade of the week focuses on silver and lower nominal and real rates and the prospect of greater ETF inflows. Here's the chart they associate with it. Now, I'm going to read a little bit from the report, and then we'll go into what it means a little bit. Since the 2Q run-up in silver prices, the metal has lacked a clear trend. We believe its recent sideways trajectory will turn into a broader uptrend, with silver prices breaking out of their recent 26 to 32 range and rallying. Rate cuts and policy easing across the globe should underpin economic growth and industrial application demand for silver. At the same time, lower real rates set at the scene for a weaker US dollar and ETF demand coming out of the US and Europe. Our silver forecasts stand at $36 to $38 by the end of the year. Our longer tenors also match those forecasts, meaning they don't see any let up anytime soon. Now, what is this chart? This chart has a red line in it. Let me bring it up on our screen here. That's the yellow line. They believe that the market won't get below 26, period. They also believe that it won't get much below 28.50. And so they're advising to their clients to get bullish now by betting it won't go below 28.50. And that would be involving selling derivatives. Now, as a trader, you may say, that's risky. I might do that, but that's just a trade. And as a stacker, you may say, who cares? That's crazy. I'm not going to do it. I'm just going to stack. And I'm saying to you, it's important information because their clients are the wealthiest individuals and pensions in the world. And they're not idiots selling puts because they think it's going to go up. They're deep-pocketed people that if it does go down to $28.50 or $28, they will take delivery. So understand that below $28.50, there's probably physical demand beginning to build up. And there's buying above $32. So below the yellow line, it will get bought. And above the green line, it will get bought. Silver is in catch up to gold mode now. If we can survive the selling that's coming into gold right now through this whole buy season cycle, believe it or not, there's selling in buy season, then this market's going to go higher. Now, just to zoom out just a little bit, rather zoom in a little bit. This is the daily silver chart. This is my opinion based on the analysis. The market is a little overbought, and it needs to work off being overbought for the next 1 to 5 days. It doesn't need to work off being overbought. If it gets above that line, it's just gonna go, okay? But if it stays under that line and hovers in this area, it's building up, it's reloading the gun for another run higher. Move to a weekly. The market is midway through actually the market is bullish and tentative. So again, above 32.50, and this signal will rip. And the monthly is in midstream. It's just in the middle of the market going up. So daily 1 to 5 days. Don't be depressed if the market goes sideways for a couple of days, because once it gets above 32.50, it's going to go. The analogy would be a coiled spring. The spring unwound. It tried to get above 32.50. It didn't. And now it's got to rewind. Now, if the rewinding of the coil, the recoiling of the spring happens at a level that, say, stabilizes above 31.50, then the next time above, it's going to be, leaps and bounds. All right. Back to the rest of the report there. This week is CPI and PPI, and the markets are going to focus very heavily on this now, because now that the Fed has decided they want to ease, everyone's saying, okay, the economy is going to be fine. So let's see if inflation picks up. And inflation is going to pick up. You know that. All right. So there we are at the bottom. Bullion Bank, our trade of the week, focuses on silver, and Sunday reading that includes the full analysis on the Cold War 2.0. I'm Vince. Have a great day.